Hey guys, this is Mr. Breen, and in this video I'll be talking about financial intermediaries. So what are financial intermediaries? Okay, well, basically, we have a group of people that we'll call savers, people who have an income that's higher than the amount that they want to consume right now. And then we have another group called borrowers, who want to spend more than they have access to right now, whether in order to consume, say, a house or a car, or in order to invest that money in some business project. So some pretty likely borrowers include college students, home buyers, and businesses who have projects. Well, how do we link these with these? Okay, we could just have, a direct market where savers just lend directly to students and home buyers and businesses. The problem is that it would be hard for a student to track down all the different people he'd need to lend him that money, right? We could just rely on rich people to do all of the saving and lending to students and home buyers and all this stuff, but we can probably do better than that, and this is how. We have these institutions, financial intermediaries that pool savers' money. So savers deposit their money in the financial intermediaries, and the financial intermediaries then lend that money out. Okay, they invest that money, basically, to borrowers, whether for student loans or home loans, mortgages, or business loans, or investing in stocks or bonds, or whatever. And then the borrowers pay back interest, just like with any investment. And the financial intermediaries keep some of that, okay, so they can profit, but then they send some of that interest back to savers. Now, without these financial intermediaries, maybe, these people could go beg rich people for money to invest in various things. But instead, middle-class people, or even lower than middle-class people, can take whatever excess money they have, deposit in these financial intermediaries, and the financial intermediaries can pool all that money together and lend to all these different people. So these people know where to go to get money. They go here, okay? So what are some examples of these financial intermediaries, these people who come between savers and borrowers? Well, some of them are pretty obvious, right? Like commercial banks. So we know that commercial banks take deposits from people and then lend that money out to businesses and home buyers and students. And the same goes for credit unions, which are, they're like cooperative banks. So they're generally speaking non-profit banks, basically. Usually not as big, but they also lend money out for mortgages and they take deposits from people. There are also mutual funds, which are a little bit more specialized. So mutual funds take depositors' money and invest that money in stocks, a variety of stocks, okay? They manage that money, and it sort of works like a bank, but they just invest your money in stocks. This is a much better than savings accounts for, say, retirement savings, because the stock market generally is going to have higher growth, okay? And it's not as risky because they can do what's called diversification and buy a lot of different kinds of stocks, and if some of them fail, it's not so bad. And then also, you might be surprised to know that things like pension funds, they take the money that people pay into the pensions, that, say, workers pay into pensions, and they invest in stocks or bonds. And then the same thing goes for life insurance companies. So when you pay a premium for your life insurance, okay, when you pay that premium, the life insurance company doesn't just sit on it, okay, until you die and they pay it out to your beneficiaries. Instead, they also invest in stocks and bonds. So stocks and bonds. So sometimes you'll hear that a company has a lot of institutional investors. In other words, they sell bonds and they sell stocks. Much of their stock is owned, okay, or many of their bonds are held by institutions like mutual funds, pension funds, and life insurance companies, rather than by individual investors, just like day traders, or if you went out and bought some Apple stock Maybe a lot of companies are instead owned by things like mutual funds, pension funds, and life insurance companies.